Marco Palmero, founding director of Ulysses Investments. In this video, I want to talk with you about how we generally structure relationship with investors and third parties that want to enter our project with capital, and give you potentially more information about how this process works, because I see a lot of the times that people have questions about whether or not this is a project where you need to deploy a lot of capital early on and then wait for some specific amount of time to see a return. So hopefully I'll give you more information and details about this in this video, and you have a better understanding of how everything works. So at Ulysses Investments, we are focused on acquisition. So we buy profitable healthcare companies, specifically clinics, polyclinics, and hospitals. And the good thing about this model is that it is acquisition driven, which means every single acquisition is managed as a standalone deal. Now, what that means for an investor or a third party that wants to enter the project with capital and see a return is that you are not obliged to commit a huge portion of capital early on and then wait, or commit to the full project, because what happens is every single deal is different. You might be interested in investing some capital in a specific clinic, in a specific acquisition, because it fits your criteria as an investor, but you might not be interested in other targets. And so you have this level of flexibility in working with us, because we approach every single deal as a standalone transaction, and therefore you can mitigate your risk and your appetite for risk by looking at deals that we have, see the size of them, the level of risk, the potential rate of return that you might get out of your money, and after that decide if you want to commit for one deal, two deals, three deals, maybe more. And that is the very good thing about this model, because it allows people to have a lot of flexibility, a lot of choices. And about choices, I'd like to mention the returns and how we generally structure these things, because what people look at when they put down some capital is something like an equity contribution, right? And then a potential return over time if the business goes public or if it is sold to other parties. But in our case, we have different options and different models available for you as well, that are not only equity contribution, where you deploy some capital and you wait to get a return, but they can also be debt models where you're a private, you offer us private credit and you get paid over time with interest, or potential convertible notes where you still have debt that is getting repaid to you in the form of principal and interest, and then you have an equity kicker in the clinic that you invested in or in the whole project. That is just a very short breakdown of some of the options that we have available. But what I'm trying to say here is that there's really a high level of flexibility and a lot of options we can play with to make sure we fit your risk appetite and also the investment you want to make into a specific acquisition. And that is very interesting, because maybe you might want to commit a small portion of capital early on in a tiny acquisition, and after you see how the project is developing, you might decide, okay, now I'm going to commit to a big project. These guys are buying 2 hospitals. I want to be involved in it. And so it's giving you a high degree of flexibility in what you do and in how you can get your money back in many different ways. So obviously there's much more that I can tell you about this, but this is not the right video to do so. I hope you find this video helpful, and hopefully that answered some of your questions, and I'll see you on the next one.